Here is what nobody in Australian property media will tell you. The most expensive mistake most investors make is not a bad purchase. It is being in the wrong phase of the investment life cycle and not knowing it. Not a bad suburb, not bad timing, not bad luck. A missing map. Investment lending in Australia hit a record high last year. 40% of all new housing finance is now coming from investors. More than 57,000 new loans in a single quarter. Most of those investors are making the same decision: buy, hold, wait for the market to do something, ask whether now is a good time to move. Almost none of them have answered the question that actually governs that decision. Which phase is my portfolio in right now? That question has a name. It has a framework, and getting it wrong has a dollar figure attached to it. I'm going to give you all three today. My name is Rasti. I'm the founder of Gateway Properties, a CFA charter holder and a former quant fund manager. 9 years managing institutional portfolios worth over $2 billion at Westpac in AMP Capital. I built my own portfolio starting with $80,000, most of it borrowed. It is now worth over $15 million across 21 properties. Every one of those acquisitions was governed by the same framework I'm going to show you today. It is called the GPS framework: grow, protect, secure. This model came directly out of how institutional fund managers think about the life cycle of a portfolio. I adopted it for a private property because the underlying logic is identical. A portfolio has a life cycle. The rules that are correct in one stage are wrong in the next. And most investors are applying row stage logic to what is already a protect stage portfolio. By the end of this video, you will know which GK stage you are in, what that stage requires of you right now, and what the cost is of getting wrong. The question dominating every property channel right now is now a good time to buy? Rates have moved. APRA has changed lending rules. Some markets are running hard. So the question feels pressing. It feels like the right thing to be asking. It is not the right question. It is not even close to the right first question. The right first question is, which GPS stage is my portfolio in? Because the answer to should I buy is completely different depending on that. And most investors have never figured out which stage they are actually in. Stage 1, grow. This is the acquisition phase. You're building your base portfolio. In grow, every purchase has a written thesis before it is entered. The 24-month wait test governs every decision. What is the job of the asset? What is the finance impact? And what must be true in 24 months for this to be a win? You have pyramidal equity, using the capital growth in your existing properties to fund the deposits on the next ones. A growth engine asset where the yield stabilizer keeps the portfolio cash flow neutral while it builds. Growth ends when the blueprint says it ends, not when you feel like stopping, not when the market gets hard. When the portfolio design, your property will blueprint says the base portfolio is complete. Stage 2, protect. This is the phase nobody talks about. In protect, you stop acquiring. The portfolio keeps going in value, but loans stay roughly the same. The gap between what the portfolio is worth and what you owe widens every quarter, every year, while you do nothing except manage it well. That fighting gap is your equity building toward the number that makes wealth optional. Protect is not a waiting route. It's a job, a specific one, with a specific description. I will come to it in detail. Stage 3, secure. Secure is triggered when your net equity reaches your freedom number, the specific figure that funds the passive income your life requires. At that point, you begin selling properties strategically in the most tax-efficient sequence to repay the remaining debt. What is left is a smaller, unencumbered portfolio generating the income you designed the whole thing to produce. Work becomes a choice. 3 stages, 3 completely different sets of rules. One principle that ties them all. The GPS stage specifies what decision is correct, not the market, not interest rates, not what other investors are doing around you. A practical illustration. APRA introduced Australia's first debt-to-income lending cap this February. Banks can no longer issue more than 20% of new mortgages to borrowers with a debt-to-income ratio of 6 times or more. If you're a protect stage investor who has already stopped acquiring, This policy change is elementary. It simply does not apply to your situation. If you are a growth stage investor approaching your borrowing ceiling, it changes how you structure your next acquisition. The ceiling is information. It is often a signal that your growth stage is nearing completion and Protect is beginning. The DTI cap does not create the problem of being in the wrong stage. It reveals it. Now, the Protect stage, the phase that Australian property media has essentially never described, and the one that most investors watching this video are likely already in. If you have owned investment property in Perth, Brisbane, or Adelaide for the last 5 years, there's a real chance your equity position has moved further than you have recalculated. Perth properties have compounded close to 90% over 5 years. Brisbane around 70, Adelaide around 60. Nationally, dwelling values grew 8.6% in 2025 alone. I'm not telling you that to signal it is time to buy. I'm telling you that because the equity question, what do I do with what I have built, is entirely GPS stage dependent. The same equity position produces a completely different answer in Grow versus Protect. Let me walk through a profile I see regularly. Dual income couple, combined household income of $220,000. Two investment properties. Sydney bought in 2019, Brisbane in 2021. Current portfolio value approximately $2.1 million. Outstanding loans approximately $1.6 million. Net equity around $500,000. They have not bought since 2021. They feel maybe like they should be doing something. Brisbane has run hard. The equity has moved. They have around $400,000 in accessible equity, and they are thinking about extracting it too again. That instinct is understandable. It is also untethered to a GK stage. If this couple makes any decision, one question comes first. What is their freedom number? The freedom number is the annual passive income figure that makes work generally optional for them. Not comfortable, optional. Let's say they want $96,000 a year. Dividing that by a conservative net portfolio yield of 4%, that requires an unencumbered portfolio worth approximately $2.4 million. The growth stage target is approximately $4 million because the portfolio needs to grow by around 90% during the Protect phase to deliver the required equity at the secure trigger. Current portfolio $2.1 million, grow target $4.0 million. They have more growth stage ahead of them. But, and this is the critical step, before any acquisition decision, two things must be confirmed. Do the current buffers support an additional purchase? And does the new asset pass the 24-month twin test? What is the job of the asset? What is the financial impact over the next 12 to 18 months? And what must be true in 24 months for this to be a brand? If both questions have clear, rules-based answers, proceed. If either answer is not sure, the acquisition does not proceed. Not because the market is uncertain, because buffers before bravado is non-negotiable at every stage. Here's a GPS worked example in its simplest form. Target net wealth $3 million. Base portfolio at the end of Grow, 6 properties averaging $500,000 each. Total value $3 million. Outstanding loans $2.7 million acquired with 10% equity through the pyramid. Net equity at the end of Grow $300,000. The portfolio enters Protect. Nothing is sold, nothing is bought. The portfolio grows by approximately 90% over the Protect period at historical long-run Australian averages. Portfolio value reaches $5.7 million. The loans are still $2.7 million. Net equity now $3 million. Target reached. Secure is triggered. Properties are sold in the most tax-efficient sequence to repay the $2.7 million in debt. What remains? A $3 million debt-free portfolio generating passive income. Work is now optional. That is a plan working exactly as designed. Now, here is what happens when someone leaves Protect early. Say, this investors look at $4 million portfolio midway through Protect and decide to take profits. They sell one property at $800,000. They pay capital gains tax. They redeploy the after-tax proceeds into a new purchase. What they have done is sold during the period when the equity compounding has the longest runway ahead of it. They have restarted the clock at exactly the wrong moment. I will not quote a specific dollar figure here because the outcome depends on the property, the tax position, and the reinvestment decision. But the direction is not close. Leaving Protect early is structurally costly. It is not a timing error, it is a life cycle error. I want to address something directly before I move on. For a high achieving professional, someone used to making decisive moves, someone for whom inaction feels like failure, the protect stage is uncomfortable. The portfolio is running. Other investors are buying. You feel like you should be doing something. That feeling is real and is a prompt signal to follow. The national rental vacancy rate is currently 1.2%. Rents are growing at 5% per year. Your tenants are paying. The equity gap is widening. The portfolio is executing its design without any action from you. This is not passivity. This is the protect stage working. The investor's job description changes when the GPS stage changes. In grow, source, analyze, acquire. In protect, hold, review, manage, and resist. Specifically, do not re-enter acquisition without a new GPS plan. Do not sell to take profits. Do not extract equity for last year's spending. Do not use available water capacity just because it exists. None of those are market decisions. They are state decisions. And the GPS framework made the distinction precise. What does disciplined grow stage execution actually look like? Amy and Jack are IT and HR professionals with 2 young children. In 27 months, they built $580,000 in equity across 3 properties. One in New South Wales, one in WA, and one in Queensland. All sourced off market, all bought below market value, all acquired with a written brief and a stated asset role before a single search began. That is the 24th month when test applied at every decision. There's a job framework governing every selection. Geographic diversification, managing concentration risk from day one. And when that blueprint target is reached, growth stops, protect begins. Those are the rules, and the rules hold. So where are you on this map? Let me give you 3 questions. You will know your GK stage before I finish the third one. Question 1. Are you actively acquiring or planning to acquire a property in the next 12 months? With your buffers committed and a 24-month when test ready to apply? If yes, you're in growth. Question 2. If the answer was no, has your net equity already reached your freedom number? Has the portfolio built the equity that makes work optional? If not yet, you are in protect. Question 3. If your equity has reached the freedom number, are you prepared to begin deleveraging? That is the secure stage. Most people watching this video are in one of the 2 places. They are in pro and have not applied the full discipline of the 24-month min test and buffers before Rabado to their recent decisions. Or they are in protect and did not know it had a name or a job description. If you have owned investment property since before 2022 and have not bought since, there's a strong chance you are in protect. That is not a problem, that is the portfolio executing. Now, the freedom number calculation, 2 steps. Step 1, decide the castle income figure that makes work a genuine choice, not a necessity. Put a specific dollar figure on it per month, multiply 12. Step 2, divide that annual figure by a conservative net portfolio yield. 4% is a reasonable working number for a diversified Australian residential portfolio. That gives you the size of the unencumbered portfolio you ultimately need. Double it. That is your grow stage target. Because the portfolio needs to grow by approximately 90% through the protect stage before the secure trigger is reached. Compare that number to your current portfolio value. The gap tells you how much growth stage remains and whether the accessible equity in front of you should be deployed or left to compound. And for those of you who are sitting in protect and feeling uneasy about holding through uncertainty, the RBA's latest financial stability review found that fewer than 1% of Australian mortgages are currently in negative equity. Prepayment buffers are above pre-pandemic levels. The protect stage is not a holding pattern through danger. It is a disciplined phase in a plan that is already producing results. Send this video. You will want it when you are making your next acquisition decision. Drop your GPS stage in the comments. I read everyone, and it shapes where this series goes next. Let me bring us together and grow, acquire deliberately, written thesis for every asset, buffers confirmed before every purchase, a blueprint that defines when grow ends. In protect, hold, review, manage, resist. Let the portfolio do the job it was built to do. The equity gap widens. The freedom number approaches. Patience is not passivity. It is a plan executing. Insecure, deleverage in the right order. Sell the right assets at the right time. Repay the debt. The income that remains is the income the portfolio was built to produce. Most investors making decisions right now are doing so without a GPS stage. They are responding to market conditions, rate movements, after announcements, and the noise of what everyone else is doing. All of which are real inputs, none of which answer the prior question. What does my cheapest stage require of me right now? That question governs everything. If you want to map your own GPS stage, your actual freedom number, where your portfolio sits on this diagram today, in what your next right move is, we do a free strategy session. No pitch, no obligation. Your numbers, your blueprint, our clear answer. The link is in the description. When you're ready, it's there.